For more than 70 years, global power has rested on a single assumption that the US dollar is unshakable, not because it is perfect, not because it is fair, but because there was no alternative powerful enough to replace it. Now, that assumption is breaking. As the US dollar weakens and gold surges past $5,000 per ounce, something historic is happening, quietly, deliberately, and mostly outside public attention. For the first time since World War II, central banks are treating gold not as a hedge, but as a superior reserve asset to US Treasuries. This is not a market story. This is a power transition. And once reserve systems change, everything else follows: currencies, wars, alliances, and the cost of daily life for billions of people. To understand why this matters, we need to rewind. The modern dollar system was born in 1944 at Bretton Woods, when the U.S. emerged as the industrial and military core of the world. The dollar was pegged to gold. Other currencies were pegged to the dollar. Stability flowed from American dominance. That system formally ended in 1971 when the U.S. severed the gold link. From that moment on, the dollar was backed not by metal, but by trust in U.S. power. Military reach, economic scale, control over global finance, and critically, U.S. Treasuries as the so-called risk-free asset. For decades, Treasuries were the backbone of global reserves, but that trust has been eroding, slowly at first, then all at once. Three forces accelerated the shift. First, the weaponization of the dollar. Sanctions, asset freezes, and swift restrictions showed governments that dollar reserves are not neutral. They are political leverage. Second, exploding U.S. debt. With debt exceeding $34 trillion and rising interest costs consuming federal budgets, treasuries no longer look risk-free. They look politically unstable. Third, monetary dilution. Post-2008 and post-2020 money creation fundamentally altered perceptions of dollar scarcity. Gold, by contrast, cannot be frozen, cannot be sanctioned, and cannot be printed. That is why central banks began buying gold aggressively, not for profit, but for sovereignty. This shift is not driven by markets, it is driven by states. China has spent over a decade quietly reducing exposure to U.S. Treasuries while increasing gold reserves. Gold supports Beijing's long-term objective, weakening dollar dominance without open confrontation. Russia, after having hundreds of billions frozen, made the lesson unmistakable. Gold became not just a reserve, but a survival asset. Middle Eastern energy states, particularly those exploring non-dollar oil settlement, see gold as a neutral anchor in a multipolar world. Emerging economies, from India to Brazil, are recalibrating reserves toward assets immune from Western political control. Even European central banks, publicly loyal to the dollar system, have slowed treasury accumulation and repatriated physical gold. On the institutional level, the IMF still operates within a dollar framework, but its growing emphasis on special drawing rights reflects discomfort with dollar concentration. BRICS initiatives increasingly reference gold as a settlement reference, not a currency, but a neutral denominator. This is not anti-American ideology, it is risk management. A world where gold overtakes treasuries as the preferred reserve asset has profound consequences. For the United States, reduced foreign demand for treasuries means higher interest rates. Higher rates mean rising debt servicing costs. That forces either austerity, inflation, or political crisis. The U.S. retains immense power, but its financial privilege is shrinking. For global finance, liquidity becomes more fragmented. Capital flows are less centralized around New York. Gold becomes a strategic asset, not a relic. For geopolitics, reserve systems define alliance structures. As gold replaces treasuries, countries gain flexibility to operate outside U.S. pressure, sanctions lose effectiveness, and financial warfare becomes harder to enforce. This does not end conflict, it reshapes it. For technology and markets, gold's resurgence coincides with distrust in purely digital systems. While central bank digital currencies expand state control, gold offers apolitical final settlement. Ironically, the more financial systems digitize, the more value flows toward what cannot be digitized away. For ordinary people, currency volatility increases, inflation becomes harder to contain, and savings in fiat currencies lose purchasing power faster. Gold at $5,000 is not wealth creation, it is currency devaluation made visible. This is not the end of the dollar, but it is the end of dollar absolutism. The future likely looks like a multi-reserve world, where gold, regional currencies, and commodities coexist. The dollar remains dominant, but no longer unquestioned. Financial influence becomes negotiated, not assumed. Gold will not replace currencies. It will replace trust where trust has failed. And once central banks move first, markets follow, not the other way around. History is clear on one point. Reserve transitions are never announced. They are felt. By the time the public understands what gold at $5,000 really means, the decision will already be irreversible. This is not a crisis headline. It is a structural shift, and structural shifts decide the next century.